This deep dive is brought to listeners by VirPoint. Welcome, everyone, to another exploration of the forces shaping our world.
Glad to be here.
So today we are looking at a massive, globally interconnected story. We're talking about a rapid and, frankly, severe global bond sell-off. And it's being triggered by surging oil prices.
Which is all cascading from the escalating U.S.-Israeli war with Iran.
Exactly. For our stack today, we are pulling from financial market reports from the Star and Money Web, alongside some really fascinating platform insights directly from VirPoint.
It's a dense stack today.
Yeah.
But an incredibly important one.
Yeah, it really is. Our mission for this deep dive is to unpack the domino effect of geopolitical conflict on global inflation, explore exactly why the bond market is plunging into chaos right now, and discuss how you, the listener, can position yourself to navigate
and even capitalize on.
Right, capitalize on these massive tectonic market shifts. But before we jump in, we do want to place a quick but vital impartiality disclaimer right at the top.
Good call.
The materials we're analyzing today contain highly sensitive, rapidly evolving geopolitical info regarding the U.S., Israel, and Iran. As your guides through this stack, we are remaining strictly neutral.
Strictly neutral.
We are not taking any political sides, nor are we endorsing any of the maneuvers we'll be discussing. We're simply reporting the economic cause and effect detail in the text and breaking down how it impacts the global markets.
That is a crucial distinction. Our focus is purely on the data, the market reactions, and the underlying economic mechanisms at play here.
Okay, let's unpack this. The catalyst for the financial turbulence we're seeing is the rapidly worsening U.S.-Israeli war with Iran.
Yeah.
The immediate fallout is that this conflict has severely disrupted shipping through the Strait of Hormuz.
Right.
Now, if you follow global trade even casually, you know the Strait of Hormuz is essentially the jugular vein of the global energy supply.
Right.
But hasn't the market already priced in a lot of this Middle East friction?
You'd think so.
I mean, we've been dealing with shipping issues in that region for quite a while now. Why is the market suddenly in full-blown panic mode right now?
Well, the difference really boils down to the political context surrounding the conflict.
Yeah.
And we're reporting this neutrally based on the latest news cycle.
Okay.
Iran has recently named Mojtaba Khamenei to succeed his father as supreme leader.
Right, I saw that. Now, why does a financial market care about a political succession?
Charu Chana, she's the chief investment strategist at Saxo, points out that markets view this specific succession as a strong signal of policy continuity.
Policy continuity, so no big changes.
Exactly. To the people trading billions of dollars daily, that signals the risk of high confrontation remains elevated and prolonged. It tells the market not to expect a sudden diplomatic de-escalation anytime soon.
So it's the realization that this isn't a temporary flare-up.
No, it's not.
It's the new baseline. And when the market doesn't expect de-escalation in a region that controls so much of the world's oil, the immediate reaction is panic buying.
Pure panic buying.
The numbers here are just staggering. Since the war began, oil prices have shot up almost 80%.
80%.
We're talking about breaching the $100 per barrel mark, which, by the way, is the highest we've seen since July 2022. And it's actively surging toward $120 a barrel.
And this raises a really important point about the mechanics of fear in the market. Uncertainty is what drives prices in a crisis.
Right.
It's not just about the oil that isn't flowing out of the Gulf today.
Yeah.
It's about the fear that it won't flow tomorrow or next month or 6 months from now.
Yeah, that anticipation of future shortages.
Exactly. Ed Yardeni of Yardeni Research put it very bluntly in his analysis. He said this chaos in the financial markets won't end until ships can sail freely through the Strait of Hormuz, period.
Period.
Right.
That puts a very physical, tangible condition on a complex financial crisis.
It does.
Until those massive physical ships can move safely across a specific body of water, the digital numbers on the trading screens are going to keep flashing red. But I'm curious about the psychological threshold here. Oil has been somewhat high before, hasn't it?
It has. But Rajeev de Mello, a global macro portfolio manager, captured the psychological shift happening right now. He noted that investors felt oil sitting around $80 a barrel was manageable.
Like the economy could digest that.
Right. The global economy could digest that without breaking. But this rapid acceleration above the $100 mark has completely shocked them.
Shocked them because of the price or the speed.
The speed. The sheer speed of the move is just as damaging as the absolute price level. It doesn't give corporations or countries any time to adjust their budgets.
And if oil is rocketing to $120, that pain doesn't just stay at the gas pump, does it?
Not at all.
It bleeds into absolutely everything we buy. Which brings us to the real nightmare for central banks, the looming specter of stagflation.
Yeah, the worst case scenario.
Because oil isn't just a standalone commodity, it is the fundamental engine of the global economy.
What's fascinating here is how oil permeates every single layer of the supply chain. Tim Murray from T. Rowe Price is quoted calling oil the single most important input into global inflation.
The single most important.
Think about it. If the price of crude skyrockets, the cost to manufacture plastic goods goes up. The cost to transport those goods on cargo ships goes up.
The cost to heat the factories making the goods goes up?
Exactly. It acts as a massive headwind, especially for Asian economies that are heavily reliant on importing their energy.
Because they don't have the domestic reserves to fall back on.
Right, so they absorb the full shock of that price hike immediately.
So we're staring down stagflation, that brutal 1970s cocktail of a stalled economy mixed with runaway prices.
It's a toxic mix.
So instead of just inflation where your coffee gets more expensive but maybe you get a raise at work, stagflation is where your coffee gets more expensive but your company is doing so poorly they're laying people off.
It's an absolute worst-case scenario for central banks like the Federal Reserve.
Because they're stuck.
Completely stuck. The usual medicine for inflation is raising interest rates to cool down spending.
Right.
But if the economy is already stalling out...
The stag part of stagflation.
Exactly. If it's stalling, raising rates can choke off economic growth entirely and trigger a deep recession.
But conversely, if they lower rates to stimulate that dying growth...
They risk pouring absolute gasoline on the inflation fire. They are entirely trapped by the math here.
And we have the hard data to show just how trapped they might be. The International Monetary Fund, the IMF, actually calculated the threshold for this.
Yeah, the numbers are grim.
Kristalina Georgieva, the managing director, stated that a sustained 10% rise in energy costs lifts global inflation by 0.4 percentage points.
And shaves 0.2 percentage points off global economic growth.
So think of a 10% oil spike as a stealth tax on the entire global economy.
That's a great way to put it.
It simultaneously raids your wallet and shrinks your paycheck. Every sustained 10% jump is making life more expensive while making the economy smaller.
And remember, oil is up almost 80%.
Wow.
So if you compound that IMF math, the effect is incredibly destructive to the global growth outlook. It means margins are getting crushed everywhere.
Bloomberg Intelligence provided an even starker warning in the text. They project that if crude hits $133 a barrel, we don't just see a slowdown.
We see true demand destruction.
So what does demand destruction actually look like on the ground?
Demand destruction isn't just people deciding to take fewer road trips.
Right.
It means the price of the input has become so catastrophically high that the economic activity it supports simply ceases to exist.
Oh, wow.
Airlines cancel routes because the jet fuel costs more than the passengers can pay. Aluminum smelters, which use massive amounts of electricity, just power down their furnaces and lay off their entire workforce.
So people and businesses literally cannot afford to consume at their normal rates.
And the structural economy just breaks down.
And we're already seeing the early cracks form, which makes this threat very real, not just a theoretical warning.
Yeah.
In the United States, February saw unexpected job cuts and a rising unemployment rate.
Right, at the worst possible time.
So you have a cooling labor market right at the exact moment that price pressures are intensifying because of the oil shock. It is the perfect, terrifying stagflationary mix.
Which forces us to look at the financial fallout. When macroeconomic theory collides with the reality of global wealth, the result is what the financial reports are calling a bond market bloodbath.
So what does this all mean for you? If you're looking at your retirement account, your savings, or your investment portfolio, how does a war in the Middle East and $120 oil destroy the bond market?
It seems disconnected at first glance.
Right. I thought bonds were supposed to be the safe part of your portfolio.
To understand the bloodbath, we have to look at the core mechanism of bonds. Bonds have an inverse relationship between their prices and their yields.
Inverse meaning they move in opposite directions.
Exactly. When bond prices fall, the yields, meaning the interest they pay out relative to their current price, rise.
Okay, got it.
Conventionally, you're absolutely right. Bonds are supposed to be the ultimate safe haven. When stocks get volatile, capital floods into government bonds because they guarantee a fixed return.
But the catch right now is inflation.
Big time.
If you lock your money into a 10-year bond, paying a 4% yield, but inflation is running at 6% because oil is through the roof, you're actively losing 2% of your purchasing power every single year.
The bond's safe, fixed return is just being eaten alive by inflation.
So investors dump the bonds, prices plummet, and yields skyrocket.
Add to that the central bank dilemma we just discussed. Because inflation is surging on the back of $120 oil, the Federal Reserve simply cannot cut interest rates to save the economy.
Right, because that would pour gas on the fire.
Traders have had to aggressively adjust their expectations in real time. Before this geopolitical conflict escalated, the market fully expected the Fed to cut rates by July. They've pushed those expectations all the way back to September. And some traders in the options market are betting on no rate cuts at all this entire year.
Wow. So the Fed is backed into a corner. But how is the actual bond market reacting on the trading floor today? Give us the global tour because it really emphasizes how interconnected everything is.
It is a totally borderless sell-off.
Okay.
In the U.S., during Asian trading hours alone, the 2-year Treasury yield, which is hypersensitive to what the Fed is expected to do, jumped nearly 6.7 basis points to 3.6226%.
Okay.
The 10-year yield rose more than 7 basis points, which is the biggest single jump we've seen since January.
For the listener who doesn't stare at bond screens all day, is the 6 or 7 basis point jump actually a big deal? It sounds like a tiny fraction.
In the bond world, where massive institutional funds trade on fractions of a percent, a 7 basis point move in a few hours is a seismic event.
Really?
It represents billions of dollars in bond value being wiped out as investors stampede for the exits.
And it doesn't stop in North America.
No. Look at Australia. Their 3-year government bond yields surged an incredible 16 basis points to 4.592%.
16 basis points.
That is the highest level they have seen since mid-2011. The 10-year yields down under hit nearly 5%.
And it's not just the U.S. and Australia. The bedrock of European debt, German bunds, and French OATs are plummeting to nearly 15-year lows.
We're talking about the financial anchors of the Eurozone experiencing historical sell-offs simultaneously.
We see the exact same panic confirmed in Asia. Japanese yields jumped across the entire curve.
That is putting intense downward pressure on the Japanese yen as capital flees the currency in search of stability elsewhere.
But this next detail from the MoneyWeb report is perhaps the most telling indicator of how pervasive this fear is.
The Chinese bonds.
Right. Chinese 30-year bond futures were initially acting as a safe haven when the Iran war first began. Investors parked their money there.
But now they just posted their biggest drop of the entire year.
Why the sudden reversal?
Because even China, with its massive state-managed economy, is terrified of imported inflation driven by these astronomical oil prices.
Of course.
If global oil stays above $100, China's cost to manufacture and export goods skyrockets, fueling domestic inflation. So investors realized there is no safe harbor, not even in Chinese 30-year debt.
If we connect this to the bigger picture, bonds are broadly, globally, losing their traditional safe haven allure.
They really are.
The old paradigm that most of our parents use, the 60-40 portfolio, where you keep 60% of your money in stocks for growth and 40% in bonds for safety, that was designed for an era of stable inflation and peaceful globalization.
And we are clearly no longer in that era.
When both ends of your portfolio are bleeding at the same time, what is the alternative?
That is the exact dilemma facing modern traders. When the traditional safe havens fail, when stocks are volatile due to stalling growth and bonds are losing value to rampant inflation, you cannot rely on passive strategies.
You just can't.
The current climate demands agility. You need tools that allow you to pivot your strategy as fast as the headlines out of the Strait of Hormuz change.
And this brings us to a fascinating discussion on modern trading mechanics, which is where the insights from VirPoint become incredibly relevant.
Right.
If the macroeconomic weather report says a hurricane is coming, you don't just sit in a lawn chair and hope for the best.
Obviously not.
You need a modernized toolkit. VirPoint's CFD brokerage is built specifically for this type of volatile, fast-moving environment. They allow traders and investors to capitalize on their specific investment thesis, whatever that might be.
Consider the flexibility that requires. If your thesis is that oil is going to $150 a barrel, and you want to capitalize on that momentum, you need a streamlined way to act.
Right away.
If you believe certain commodity-heavy nations will benefit, or that specific tech stocks are actually resilient to stagflation, you need seamless access to those markets.
Let's look at the key platform features outlined in our stack, starting with what feels like the most crucial right now, multi-asset agility.
Essential.
VirPoint allows users to trade across a massive spectrum from a single powerful account. We're talking about ETFs, stocks, forex, digital assets, and crucially right now, commodities.
Everything in one place.
Exactly. So if you're watching the surging oil market and want to take a position, you don't need to go through the headache of opening and funding a separate specialized commodities account. You can execute that trade right there alongside your equity portfolio.
That consolidation is a huge advantage when seconds matter and market sentiment is shifting by the hour.
Definitely.
But access to the markets is only half the equation. The other half is execution. VirPoint emphasizes what they call precision and intelligence.
Right.
They are merging cutting-edge AI tools with expert human insight.
Which is vital when you're dealing with a market reacting to real-time geopolitical events. Having AI-driven data analysis combined with human macro expertise allows for real-time execution and data-driven decisions.
You aren't just flying blind on raw panic or Twitter sentiment. You have a system designed to cut through the noise.
Furthermore, there is the cost efficiency factor. Frictional costs, the fees you pay just to participate in the market, can drag down portfolio performance significantly over time.
They really add up.
In an inflationary environment where every single dollar of your purchasing power is already under attack, saving on unnecessary bank charges is paramount.
VirPoint's transparent pricing structure is a massive benefit here. They offer commission-free trading with no hidden fees, stepping away from the outdated fee models that traditional investment firms often hide in the fine print.
The philosophy is simple. You keep more of what you earn. By stripping out the legacy costs of traditional finance, the platform ensures that your capital is fully deployed toward your actual trading strategy, not eaten up by administrative overhead.
It's about taking active control of your financial destiny when the passive systems break down.
Let's summarize the incredible chain reaction we've unpacked today because it perfectly illustrates how fragile and interconnected the global economy truly is.
Okay, let's recap.
We started with a severe geopolitical conflict in the Middle East, specifically the escalating war between the U.S., Israel, and Iran.
And the realization that a change in leadership likely means prolonged confrontation.
That geopolitical reality immediately threatened the physical shipping lanes in the Strait of Hormuz. That physical bottleneck caused oil prices to skyrocket past $100 a barrel, hurtling toward $120.
Shocking investors who thought $80 was the ceiling.
That massive surge in the foundational input of the global economy ignited deep fears of a 1970s-style stagflation. A paralyzing scenario of stalling economic growth combined with rampant, unmanageable inflation.
And those stagflation fears, reinforced by IMF warnings of demand destruction, bled directly into the financial markets.
It caused a historic, coordinated sell-off in global bond markets from Tokyo to Sydney, from Europe to the U.S.
As investors realized, their fixed returns would be devoured by rising prices, and central banks were too trapped to lower interest rates to save them.
Which brings it all back to you, the listener. The old rules of a set-and-forget portfolio are being aggressively tested by these global events.
You can no longer just buy a traditional basket of stocks and bonds and assume the macroeconomic weather will remain sunny.
The environment requires active, informed participation. Platforms like VirPoint are more relevant than ever because they provide the agility, the multi-asset access, and the low-cost structure needed to actually navigate these storms rather than just getting battered by them.
Absolutely.
Now, to wrap up our deep dive today, we want to leave you with a final provocative thought, something for you to mull over that builds on everything we've discussed. We've talked extensively about the immediate crisis, the war, the oil spike, the bond sell-off. But what about the long-term structural shift?
That's the real question. If the geopolitical fragmentation we're seeing right now makes high energy prices a permanent fixture of this new decade, how does that fundamentally rewrite the rules of globalization?
Think about it. For the last 30 years, the global economy was built on the assumption of cheap, secure energy facilitating cheap global supply chains.
Right. A component could be mined in Africa, shipped to Asia for assembly, and sold in North America, all because the fuel to move it was practically an afterthought.
But if every single country now has to prioritize energy security and supply chain resilience over simply finding the absolute cheapest imports, Are we witnessing the end of the globalized supply chain as we know it?
If the world fractures into isolated regional energy blocks just to guarantee the lights stay on, the stagflation we're seeing today might not just be a temporary shock.
It might be the painful birth of an entirely new, structurally more expensive global economy.
It is a profound question. If the cost of simply moving goods across an ocean becomes a premium rather than a given, it will dictate corporate strategies, national policies, and market trends for years to come.
Something to definitely keep your eye on as you watch these markets evolve. Thank you so much for taking this deep dive with us today. We love unpacking these complex webs of cause and effect, and we hope this is giving you a clearer lens through which to view your own financial strategies this week. Stay curious, stay agile, and we will catch you on the next one.